Today we will be covering two topics. Firstly, the latest position regarding VAT on pension services, and secondly, the evolving topic of pension scams and what we can do to protect members from them. I'm Paul Darlow and I will be chairing today's session, and today I am joined by two representatives of law firm Pinsent Masons, Mark Baker and Darren Mellor-Clark. As I mentioned, we have two topics for today's session. Firstly, VAT on pension services. Today we will look at the latest position and then consider the implications for both defined benefit and defined contribution pension schemes. We will then look at the actions that can be taken now, together with what is expected over the rest of this year. Mark and Darren from Pinsent Masons will talk you through this topic. We will then look at the topic of pension scams, and in particular, we will consider the role of the trustees in guarding against pension scams, both in terms of the actions suggested by the pensions regulator, also the pensions ombudsman, and the recent code of good practice, and I will talk you through this issue. Now, we've allowed time for a few questions at the end of the VAT session, and also at the end of the pension scam session. So please do submit questions as we go through today's event. And you can do so by typing your question in the box shown on your screen. We will post a Q&A document on our website shortly after today's webinar, covering any questions that we do not get time to answer on today's call. So without further ado, I will now hand over to Mark and Darren, who will talk us through the subject of VAT on pension services.
Okay, thanks, Paul. So Darren and I are going to talk through the VAT changes and the effect that they have for pension schemes and employers. It's fair to say, I think, that this is a notoriously complicated area, and people who have started looking at this and looking at the impact of it over the last few months, it hasn't been easy to get to grips with exactly what steps you need to take. But I think we're getting close to that point now, and so in this talk, we're giving a very strong focus on the specific steps that you need to take over the next few months. There's I think it's fair to say that on the call there's a range of different types and sizes of employers and schemes, and we'll come on to that in a second. Different sizes of scheme are affected in different ways. So what we'll be doing here is covering the angles for all types and sizes of schemes, making it as simple as possible where that's appropriate, but also looking in more detail at the specific ins and outs for bigger schemes in particular. So it may be that some of the stuff that we're talking about here are things that some of you will be familiar with already, but even so, that's a helpful recap before we then move on to the slightly more complex stuff as the talk goes forward. So on this first slide here then, what we're giving is a simple overview and breakdown of what type of action you need to take depending on what kind of scheme you run. So have you got a defined benefit scheme, a defined contribution scheme, or both? Well, if you've got a defined benefit scheme, a DB scheme, then if your scheme has segregated investment arrangements, then yes, you certainly will need to be taking action and doing that in the coming weeks. If you have pooled investment arrangements and a separate administration contract, then there's less action that you need to take, but there is still some action that will be involved connected with the administration agreement, and we'll come on to that and explain that later on. And then if you run a defined contribution scheme, then thankfully the answer is that there is less action that's needed for you. If it's a trust-based scheme, which holds a life policy, then we're expecting that there won't be any major action needed, at least right at the moment, and that's the case whether it's a bundled or unbundled arrangement. And also, if you run a GPP, let's say, for example, that you have a GPP, a group personal pension that you use for auto-enrollment, then there shouldn't be any action needed, at least for now. So the steps that are needed are more connected with defined benefit schemes. I guess there is a question there, do you know at the moment whether your scheme has segregated or pooled investment arrangements? If you're not sure of the answer to that, then you should speak to your investment consultant or the investment managers and ask them. In most cases, it should be fairly clear to work out the answer to that question. as a rule of thumb, I guess if your scheme is about 200, 300 million or lower than that, then the chances are that you probably have pooled investments rather than segregated. If you're 200 million, 300 million upwards, then you might have some segregated mandates. And even if your scheme is much larger than that, it may be that some of your investments are segregated and some are pooled. So for bigger schemes, 1 billion plus schemes, it may be that you have 8 or 10 or 12 different investment managers. You have to go through the list and work out which ones are segregated and which ones are pooled in order to know what action to take. But in most cases, once you look at that, that shouldn't be a terribly complicated thing to do. So we're going to start by giving a quick recap then of why this has come up as an issue. I mean, this is the thing emerging from the EU court decisions over the last few years in the PPG and ATP cases. Why this has come up as an issue, and the very simple overview, drawing it right back, of what this means for schemes. So as a starting point then, historically, the way it worked, the rule that HMRC had was that your administration contract, the VAT payable on those fees, could be recovered by the employer, offset against the employer's output VAT, whereas your investment agreements weren't recoverable by the employer because they were seen as just a part of running the scheme. So taking it back to a very simple level, that was HMRC's starting point historically. And you can see on this slide, we've given an example of that. It's a slightly artificial one, that let's say that your administrator charges you fees of £40,000 a year. Well, that's great because the VAT on those would be recoverable through the employer. In effect, then you're not paying any VAT on those fees because it's recoverable. Let's say that your investment contracts, you're paying fees of £60,000 a year. Well, on those, in many schemes, you won't be able to recover the VAT historically, and therefore you'll be paying £12,000 worth of VAT on those 60,000 fees. Now, the exception to that, as it says in the bottom right-hand corner of the slide, is if the scheme has its own VAT registration, then it may be that the trustees could recover that VAT. We'll come on to that later on. So that was the starting point as far as HMRC were concerned. HMRC then had this other separate rule where they said that if you have one single contract for all of your pension services, then rather than trying to work out what fraction of that related to administration and what fraction related to investment, they would allow you to use this notional 70-30 split. And so, you can see easily enough that if you have an insured pension arrangement, if it's quite a small scheme, then you might have one single contract with the insurance company, and that works. That all makes sense. And if you have this 70-30 split, then on the right-hand side, that would mean that the 30%, which is treated as relating to administration, you'll be able to recover the VAT on that. The 70%, which is treated as relating to investment, the employer won't be able to recover the VAT in the same way as in the left-hand column. What's happened then over time is that a lot of providers, including investment companies, have started to use this 70-30 split in their invoices, even where, strictly speaking, it probably wasn't appropriate for them to do so. And so there are lots of schemes out there, including bigger ones, where at the moment they've been receiving invoices for many years from their providers where the fees are split in this way, and therefore they are recovering 30% of the VAT through the employer. And I think we can draw Darren in as the VAT expert at this point, but I think it's fair to say, isn't it, that for some time HMRC has been uncomfortable with the way that arrangement is used.
I think that's certainly right, Mark. There was a consultation exercise a few years ago where HMRC wanted to withdraw the 70-30 split. The industry protested quite strongly, and so a compromise agreement was left in place whereby it could continue to be used, subject to there not being any better data available. I think that the advent of the PPG case and this re-look at the way in which VAT on pension costs, such as investment management and administration, is recovered by the employer and the scheme, has really come as something of a boon to HMRC, because finally they see this as a justification of withdrawing the use of this concession that they are aware has been employed far too widely in the market for a number of years, at least as far as HMRC is concerned.
Yeah, that's right. And it's come through a slightly roundabout route then, because if we look at the effect of the European court cases first, what the EU court was saying was that all of the VAT on all of these services can be recovered by the employer. And so, if you're an FD or even a pension trustee, that's great news, isn't it? HMRC then, over the last 18 months, has been trying to rework its guidance as a result of that, and they had to have a couple of goes at getting that right. And where HMRC has come to in the end is saying, well, yes, okay, we go along with the EU court approach. 100% can be recoverable through the employer. But, this is the tricky bit, only if the employer is a party to the contract with the administrator, with the investment manager. And so this is the bit that needs action now, and I guess many of you will have been looking at and talking to your advisors about over the last few months. So what does that mean for you right at the moment? Well, the easiest example to look at is a defined benefit scheme with these segregated investments. The simple answer then is if you are able to sign an agreement with your investment manager that has the employer as a party to it, then you will be able to recover 100% of the VAT through the employer. In other words, if you can sign a tripartite agreement, that's the sort of jargon phrase. If you don't, so in other words, if you don't do anything over the next few months, then you won't be able to recover any of the VAT through the employer. Now, on the right-hand side, we've got a couple of points there, and I guess with the yellow box, it's worth noting that even once you sign the tripartite agreement, of course, you'll still only be able to recover the VAT if the employer has tax that they can offset it against.
That's right, Mark. And I think just to clarify that for the purposes of the call, generally speaking, most industrial and commercial sort of real economy companies are able to recover, generally speaking, all of the VAT they incur that relates to their business activities. There are a number of institutions and businesses for whom there is a restriction in place, and these businesses are referred to as partially exempt businesses. I would say typically those are within the financial services arena, the educational arena, the provision of healthcare. Those institutions may find themselves with a restriction in the employer. But I think generally speaking for most industrial companies, yes, very definitely they could recover all of that input tax.
Yeah, okay. And on the second point, the one about if you don't take any action, if you don't put a tripartite agreement in place, we've said there that that will mean you can't recover the VAT unless the scheme has its own VAT registration.
That's right, very much an independent registration, typically in the name of the trustees, and that will then allow the scheme itself an independent right to recover VAT it incurs, depending upon the nature of its business.
Yeah, and it's fair to say that some schemes will have their own registration at the moment. It probably depends on what sort of investments you've got.
It does, yes.
Okay. Good. All right. So that is broken down to what the steps you need to take over the next few months. The other thing worth noting then is that if your suppliers do currently use this 70-30 split, HMRC has said that it will allow that arrangement to stay in place up to the end of December, and then after that you won't be able to recover under that rule. And I think what we're expecting there is that it means that as long as the provider sends you the invoice by the end of December, you will be able to recover under that split.
That should be broadly correct, yes.
Yeah, okay. So in terms of timing, and this is the bit that's been difficult, I think, over the last few months, a lot of you will have known that these changes are coming, and you're being told that you need to do something about it, but it's hard to figure out exactly what steps you need to take when. I think now it's becoming a bit clearer. So if you have got segregated investment arrangements, then the way this is falling into place, you should be taking action on that now. There's nothing to stop you doing that now. You should be speaking to your investment managers and saying, can we put these tripartite agreements in place? And then the other things on this slide show the other steps that are expected over the next few months. So at some point, we're going to get more guidance from HMRC, but only on the bits around the edges. So, for example, actuarial legal contracts will come onto later on, and also hybrid schemes. That will come at some stage over the next few months, but we're not sure exactly when, and I think we're not waiting with bated breath.
I think that's right, Mark. Certainly discussing this with some contacts over at the policy division in HMRC, I think they have an awful lot on their plate at the moment, both within financial services and the wider economy. So although they are doing their best to produce guidance, yes, I don't think we should wait with bated breath. That it could come very late in the year, which of course is going to push the timeline for any effective changes.
Yeah. Okay. Hence the point that certainly for segregated agreements, you should be going ahead with it now. And then towards the end of the year, well, we said in December, if you're using the 70-30 split currently, then you should ask your providers to make sure they send you an invoice by the end of December, rather than the Q4 invoice coming in January, because then there's a danger that HMRC won't allow you to recover the 30% of the VAT. And the other thing which we'll touch on slightly later is that as well as speaking to investment managers, you should speak to your administrators, probably not right at the moment, but at some stage over the next few months towards the end of the year, to ask them whether they will be able to update their agreements to put them in tripartite form. And so effectively the end of December becomes a deadline for some of these things, the 70-30 split, for example. But if some of these steps drag beyond the end of December, it's not an absolute disaster. It just means that you'll be losing a bit of VAT that you could have recovered otherwise. So, for example, these tripartite agreements, try to sign them by the end of the year. If that's not quite possible, then get it done as early as possible in 2016. Okay, so the area that I think is the trickiest and needs most discussion is putting a tripartite agreement in place with a segregated manager. And Darren, do you want to give an overview of the issues that you need to think about there?
Yeah, absolutely. I think it's worth clarifying just for the benefit of the people on the call that there are two independent strands currently running through the whole VAT on pensions debate. At the moment, and the purpose of this call is very much to focus on the situation where a scheme or the employer has incurred VAT that has been charged to it by its suppliers, and how is that recovered from HMRC as an input tax credit. I think that the flip side to that debate, and it certainly has been running through the courts for some time, is the question of should the suppliers be charging VAT in the first place. Now, I don't want to cover that in detail on this call because I think that we will run out of time very quickly. But the broad pattern has been that the case law to date has said that the management of a defined benefit scheme has always been and will continue to be subject to VAT. The primary reason being that because a defined benefit scheme does not qualify as what's called a special investment fund under the VAT legislation. Then a further case which looked at a scheme that looked very much like a defined contribution scheme. It was actually a reference from Denmark, so the terms defined contribution were not used, but the characteristics of the scheme were the same. And in that, the European Court held that the management of that vehicle could qualify for exemption, because it is what's called a special investment fund, for which the European legislation provides a specific exemption. So the ongoing and expected area of continued trouble is really around defined benefit schemes, although having said that, HMRC is in discussion with a number of suppliers of services and their trade associations as to the precise scope of the exemption around defined contribution schemes. So it is worth very much checking, I would say, if you are the trustee or responsible financial person for a scheme, to identify where you are currently being charged VAT and to proceed appropriately. Having said that, let's look at the defined benefit arrangements. And as Mark said, HMRC have come out with this tripartite structure for recovering VAT incurred in this situation. I think it's fair to say that the tripartite structure is really in place to defend a position that HMRC are currently taking in the courts as to who receives the supply of services and who may recover it. But it is also looking at drawing a line in the sand between VAT that's been incurred retrospectively, at which the schemes could potentially recover for the employers could potentially recover for the last 4 years, versus VAT recovery on a going forward basis. And this tripartite contract has really been put in place to service the going forward position. And what it really says is, obviously, there will need to be a contract in place which encompasses the supplier of the services, the employer, and the pension scheme. What is critical, though, is that HMRC have said that the employer must be a party to the contract and broadly must pay for the services that are received. Now, that point about being a party to the contract is worth exploring, because it's not enough simply to put the name of the employer on the contract, nor is it enough simply to have an obligation for the employer simply to meet the costs of the service provision under the contract. It must genuinely receive the services. And HMRC has put out some guidance on that in a Revenue and Customs brief earlier in the year. And I won't go into it in huge detail, but for reference, it is Revenue and Customs brief 08/15. And it really gives some guidance as to what HMRC as a bare minimum of provisions for the tripartite contract. And it makes reference to the employer paying directly for the services that it receives, the fact that an employer must be entitled to terminate the contract as well as the scheme, the fact that the employer must have a right to legal redress under the scheme, so effectively it must have a right to sue for non-performance or poor performance or similar rights that one would normally expect under a contract. And it must also be the case that the employer is effectively will only pursue, the service provider will only pursue the employer for payment in circumstances where the employer is unlikely to pay because it's gone into administration or something similar. So they are very keen to have a situation whereby it is not just a paper tiger. It is very much that the employer is seen to receive these services, have a right to see information and reports provided under the contract, and also have a right to terminate and alter the contract, all of which potentially could have an impact on the position under the Pensions Act. But those are the sorts of conditions that you will need to encompass within your tripartite contract. I think in looking at how you go about this, bearing in mind that we have to agree these arrangements by the end of the year, if you wish to take advantage of the new position for recovery, because the 70-30 split will end by the end of the year. So at that point, it begins failure to implement begins costing real money. I think obviously looking to prioritize the suppliers that you are going to enter into negotiations with to effectively look at where the vast majority of VAT is incurred and covering those suppliers first makes perfect sense. A question that has come up is whether or not we would renegotiate the entire contract or whether the changes would be made via a side letter to the contract. Now, of course, the risk is that whenever a contract is opened for negotiation, it's not merely just your points that are up for negotiation. It is points from all parties can be raised into the negotiation process. And also, we've noted that there is a restricted timeline. So it may very well be that a side letter altering certain terms and conditions in the contract may be more appropriate in terms of containing the process and ensuring that it occurs within the correct timeline. Will that be effective? Well, From a contract law perspective, a side letter is basically just as good as evidence of agreement between the parties as renegotiating the entire contract. From an HMRC perspective, we have actually written to HMRC and asked for their view on this, and the answer that came back was they wouldn't be drawn and wouldn't give specific rulings for specific circumstances at this stage. However, what was clear is that they didn't reject the idea of a side letter. So I think it's fair to say that a number of businesses are proceeding on the basis of using a side letter instead of renegotiating the entire contract. Another point that has come up is whether it's necessary to enter into individual discussions or negotiation processes with suppliers, or whether there will be, particularly on the investment management side, whether there will be some industry template that can be used and just solves the problem for everybody. I think that the Investment Management Association puts out a document known as IMA1, which is a model template for investment management services provided. They are in discussion, along with a number of other trade associations, with HMRC in terms of changing the provisions of IMA1. The timetable for when that will be released is currently uncertain. And also, I think from a practical point of view, it's certainly our experience that very few pension schemes precisely use the terms of IMA1. So I would advise against relying and assuming that IMA1 and a renewed version of that will be the panacea for all of these requirements. I think entering into individual discussions is probably key. There are one or two other practical issues to go through. Obviously, because it will be a tripartite arrangement, both parties on the buy side, for want of a better word, the employer and the trustees will need to be involved in these discussions. It really won't be possible to proceed just simply as the trustees or as the employer. But what we are seeing in a number of circumstances is the trustees and the employer agreeing what type of changes need to be made, and then the employer taking the lead in terms of discussing those changes with the relevant suppliers.
It's an interesting one, that, isn't it? Because one scheme that I work with, they're currently working out whether they want to go through that process or not, because in that case, getting employer approval for every new IMA will involve quite a lot of work. It will involve going back up to the top company in the chain and getting their authorization. And so that involves looking at how much VAT are you paying at the moment, how much do you stand to gain from it, and are you happy having to go through that process each time? And I guess that there may be some other companies that have to work that out.
Indeed. Yep. And then I guess we move to the pooled funds arena, and probably there is less attention required, and the reason for that is generally speaking, pooled investments tend to be held within vehicles that are separate to the scheme, obviously, and they generally qualify for exemption within their own right as special investment funds. So it is the usual case that VAT is not charged on the management of those vehicles, and so therefore there is probably less focus required on them, but it is, as we said earlier, it is always worth checking to ensure that is indeed the case. I also just wanted to mention retrospective claims. I think I already spoke about those. The conditions that HMRC have set for implementing the European Court decision in PPG are by no means the only representation of the decision that the court made, and indeed many are of the view that they don't implement the decision widely enough. There are a number of employers out there who have made what are called protective claims because they believe that HMRC's implementation doesn't give full force to the law that the European Court to be held to be true. HMRC is looking very strongly to resist those claims, hence its current guidance which puts in place the tripartite mechanism. It will, although if there is a lot of VAT at stake, I would say it is well worth considering an employer making those retrospective claims. I think we should be very clear that it is almost certain that further litigation would be required to successfully pursue those claims against HMRC. It's very unlikely that they would roll over and agree under the current arrangements. So at the present time, there are a lot of claims currently stood over with HMRC. HMRC are watching a case for the University of Cambridge, which was recently heard in the upper tribunal, which concerned a very similar arrangement with the university's endowment fund, where the university actually won the rights to recover VAT on investment management fees. And I believe it's quite likely that a number of the pension fund cases may very well move to stand behind the determination of the issues within the University of Cambridge case. So worth exploring the possibility for retrospective claims if you have a lot of VAT at stake in the last 4 years. If there isn't a significant amount at stake, then potentially I suspect the hassle factor of trying to pursue a successful claim against HMRC outweighs the financial benefit. And I think that was all I was going to say on that point.
Yeah, okay, so that's investment agreements, which I think is the one that will take the bulk of the work. We then look quickly at the other types of contracts that you have with your providers. And so administration agreements first, and I think this is important because this will affect not just schemes that have segregated investments, but it will also affect schemes that have only pooled investments, including some smaller ones. You'll all have an administration contract, and so this will be relevant to all of you. In principle, then, the issues here are kind of the same as they are for investment agreements. And so you can see in principle that it will be a good idea to put a tripartite agreement in place with your administrator. The difference is, I guess, that the amounts of money involved tend to be smaller, and so there is less focus on treating this as a priority. What we're expecting then is that this is something that will start to happen over the next few months, and probably towards the end of the year, start of next year, administrators might be in a position where they can put forward tripartite agreements or side letters for people to sign. It is slightly different as well because, you know, updating your IMA to put it into tripartite form is a sort of relatively simple, clean-cut thing to do. You can see which bits need to be changed and which bits don't. Administration agreements, by their nature, are slightly more complex, and if you're changing some parts for one reason, often you end up changing other parts of the agreement as well. So it's a slightly different task, and I think we would see that as lower down the priority list at the moment. It may well be that for administrators, using a side letter becomes a popular approach. And then the other types of more minor agreements, and we've listed them in the box there, so the appointments of your actuary, investment advisors, legal advisor, and so on. Again, the amounts of money involved here will be smaller, and so we don't see these as such a high priority. In principle, it may be that HMRC will look at these the same way, except the problem here is that the conflict issue gets drawn out. I mean, if you've got a contract with your legal advisor, for example, between the trustees and the legal advisor, you wouldn't really want the employer to be a party to that contract because the duties of confidentiality are so important. So at the moment, that's sitting with HMRC to try to give some guidance on how it expects people to address that. But that's the one we mentioned earlier. We're not holding out any hope of getting that guidance quickly. They said by the end of the summer, but we expect that it will take longer than that. So our suggestion here is that for these other types of contracts at the moment, just take a watching brief, but don't worry about taking any action. And then finally, defined contribution schemes, we've mentioned throughout. And the simple answer for these is that if you run a DC scheme, you probably don't need to take any action because, as Darren said, that this separate exemption for them. There are some little question marks around the edges of that, and it may be that HMRC will give more guidance on those, but we're expecting that you don't need to take any action because you effectively won't be paying the VAT on those anyway. The complication there is if you have a hybrid scheme, that's one of the things that HMRC is due to cover in its guidance. I think if you have a scheme where it has a DB section and a DC section and the two are distinct, then the right thing to do is to treat those almost as if they were two separate schemes, and so the DB section you should go ahead now and make the changes, and then treat the DC section as if it's a separate scheme. Clearly, if you have a scheme where, a proper hybrid scheme where the DB and DC promises are intermingled, then it is a bit more complicated, and I think for those we will have to wait for this guidance that the HMRC is due to give. So finally then, this last slide gives an overview of the steps that you should be taking now. Hopefully this is a helpful breakdown. DB schemes on the left-hand side, DC schemes on the right-hand side. And by breaking it down into these steps, it makes it easier for you to focus on what you need to be doing now, what order you need to do things in, and which bits do you have to worry about completing by the end of the year, and which bits not. I think certainly the key one is if you have segregated investments, box number 3, you should be moving ahead now and aiming to get that completed by the end of the year.
Okay, so that concludes the part of today's session on VAT. And before we take a couple of the questions that we've been asked, it's probably worth me just confirming that Xafinity are indeed in the process of having tripartite agreements drafted covering the services that we provide. And once they are ready, we will contact those of you on this call who are clients of ours to let you know. So, as I say, we've had a large number of questions, and I'll take a couple of them now. Perhaps the first one that is worth taking is, do HMRC's requirements breach the regulatory position as regards trustee independence, etc.?
Yeah, that is a slightly complicated issue. I think for investment agreements, it's not such a worry because it's possible to make the contract work in that way. And in fact, when you see the changes that are needed to the investment agreement to make it work, they're not too complicated. You don't need too much extra text. The way it will work is that the agreement will have the employer and the trustees as a party, and a lot of the way through it refers to both of those, but then in some places it will say it's the trustee in particular that has that power. So, for example, you need to preserve the power for the trustees to make changes to the investment arrangements, even if the employer hasn't given its consent. So for investment arrangements, there is a path through it. For the other things like legal and actuarial, more complicated.
Okay, great. I think we've got time for one more question now. And the question is, with no tripartite agreement in place, can the pension scheme become part of a VAT group with the employer to ease the red tape and the need for a separate VAT registration?
Yeah. I'm happy to deal with that. I guess the short answer is yes, subject to conditions. Basically speaking, that group membership is only open to corporate bodies. So for pension schemes, if we think that they normally are arranged via trustees, it should be possible from a VAT perspective for a pension scheme with a corporate trustee to join the employer's VAT group via the corporate trustee. So it will be possible to meet the VAT grouping provisions. What I would counsel there, though, is to consider the possibility that VAT grouping and the issues that VAT grouping brings with it, and the key one of those is that VAT group members are jointly and severally liable for the VAT debts of the whole group. And so by the trustees joining the VAT group, there is a possibility that they could be exposed to VAT debts for the trading companies within the VAT group. Now, HMRC's guidance does say that they have taken legal advice and that it appears that they may well not be able to access the assets of the pension scheme to satisfy those debts unless the VAT debt is specifically in regard to the activity of the pension scheme itself. So there is some protection, but I would recommend that the trustees consider the joint and several point when they're taking any decision about joining the employer's VAT group. And just as a final question, once the scheme, final aspect to that question, once the scheme joins the VAT group, it will need to consider how and on what basis it recovers VAT within the VAT group. Because HMRC in discussions have been quite clear that, let's say, for instance, a pension scheme joins the VAT group of a major industrial, the industrial would normally recover all of the VAT it incurs, but should the pension scheme join its VAT group, HMRC will expect to see some form of agreement reached with them, which is called the partial exemption method, which looks to analyse how the services are used. And to the extent that the services are used and the VAT on those services is attributable to the conduct of VAT-exempt investments, so trading in securities, etc., by the pension scheme, it is quite likely that that VAT would remain irrecoverable. So the VAT grouping route is one to pursue, it's one to consider, but I would say it comes with a number of caveats that are well worth pondering before taking the leap.
Okay, thanks. So that's two of the questions. As I say, we had a number of other questions on VAT, which we will answer in a Q&A document that we will post on our website shortly following this session. We'll now come on to the topic of pension scams, and in particular, we'll consider the scams that can arise as part of or subsequent to a member transferring their benefits from one pension scheme into another. And broadly speaking, there are two main types of pension scams. The first, generally known as pension liberation. And pension liberation normally involves a member transferring in order to get access to their pension before age 55. And whilst we all know that accessing a pension before age 55 is normally not possible, members of the public often don't realise this, and pension scammers take advantage of this lack of understanding. They will often tell members that they can access their pension whenever they want if they transfer their pension into a new vehicle. And this new vehicle is often established specifically for the purposes of enabling members to access their benefits early. And it's often not a legitimate pension scheme and not a pension scheme into which members often have a statutory right to transfer their benefits. Now, if the member does unwittingly transfer their benefits to such a vehicle, the scammer will often charge the member a significant fee for arranging the transfer, and in some cases will subsequently steal the entirety of the member's transfer value. But that's not, unfortunately, the only problem that the member faces. An unauthorised payment is normally involved, and therefore significant tax charges can also fall due on the member from HMRC. So from the member's perspective, under pension liberation, they can lose their entire pension and on top face significant fees and charges. From the seeding pension scheme's perspective, significant tax charges are also likely to be levied in respect of the unauthorised payment, and from the trustee's perspective, clearly their members are at risk of losing their entire pension. And unfortunately, even before April's changes were introduced, many members fell victim to pension liberation, and in the post-April world where everyone's talking about freedom and flexibility and not freedom and flexibility after age 55, it will perhaps be easier for scammers to convince members that they can and indeed should access their benefits early. So that's pension liberation. The second type of pension scam spans a range of activity involving the way that the transfer payment itself is invested. Now, a whole range of investment ideas can be sold to members, ideas that sound attractive on the face of it, overseas investments with promises of guaranteed high levels of return, for example, but these are often extremely risky, opaque, or simply fraudulent. And these investment opportunities can either be accessed through a defined contribution pension scheme, maybe a SAS, since clearly a high degree of investment freedom will be required, or if the member is older than 55, after the member has cashed in their DC pension pot. Like liberation, the scammer will often charge the member a fee for arranging the transfer, and the member's pension pot often ends up disappearing. Unlike pension liberation, however, no unauthorised payment is typically involved, and so tax charges from HMRC will often not automatically fall due. In essence, the transfers themselves can be bona fide. The problem arises after the transfer itself is made. And this is a difference that's crucial and worth repeating. In pensions liberation, the member typically has no statutory right to transfer to the receiving scheme, and an unauthorised payment is normally involved. By contrast, in the sort of investment-related pension scams, the member often does have a statutory right to transfer to the receiving scheme. The receiving scheme itself may indeed be legitimate, and often no unauthorised payment is made. And as I say, that difference is crucial when we consider what can be done to guard against pension scams. So what can we do? Well, both the pensions regulator and the pensions ombudsman are clear that where a member has a statutory right to a transfer payment, trustees cannot refuse to make that transfer. However, where the member does not have a statutory right to a transfer, trustees can refuse to make the transfer. So what does this mean? Well, if you recall, we said that in pensions liberation, the receiving scheme is typically not a legitimate arrangement, and the member does not have a statutory right to transfer to that arrangement. Therefore, where pensions liberation is occurring, trustees will often have the power to block the transfer. By contrast, investment scams can occur in legitimate pension arrangements, and therefore trustees often cannot refuse to pay a transfer where they suspect an investment scam might be occurring, so long as they have satisfied themselves that a statutory right to that transfer exists. And it's worth noting that the pensions regulator has specifically stated that it's not the trustee's role to second-guess the member's choice, and nor is it their role to prevent a member from making decisions which the trustees might consider to be inappropriate. Now, unfortunately, determining the existence of a statutory right to a transfer is often not straightforward and can include detailed analysis of the governing documentation of the receiving pension scheme, and this, as I say, can be time-consuming. So the question then arises, should trustees check the existence of the statutory right in all cases, or only if they have suspicions over the transfer? To address this question, in March of this year, representatives of the pensions industry published a new Code of Good Practice relating to the checks that trustees should be carrying out to guard against pension scams, and an outline of the code is provided on this slide. Now, the first step that I wanted to highlight was that when a member requests a transfer, the code suggests that the trustees should contact that member and ask them some questions to assess whether or not the member appears to be at risk of a pension scam. And these questions that you ask are designed to check whether there are any sort of telltale signs of scam activity. Questions such as, have you been informed that you will be able to access your pension before age 55? Have you been promised a guaranteed rate of return on your investments after you transfer? And how did you first start considering transferring your benefits? Is it something that you decided off your own back, or were you contacted sort of cold called out of the blue by a text or a phone call? So that's the initial step, asking the member some of these questions. And if the outcome of this initial triage, as it's termed, is that the member does not appear to be at risk of a scam, then trustees can, under the code, pay the transfer without assessing the existence of the statutory right. If, on the other hand, the initial triage raises some concerns, then under the code, additional diligence is required, including, in some cases, establishing whether or not the member does indeed have a statutory right to a transfer. Now, the data gathered by the trustees in this initial diligence step is clearly crucial to the whole process, since it determines whether the trustees automatically proceed with the transfer per the code, or whether more detailed diligence is required. And so, given the importance of this initial triage step, I think it's worth considering how this information is gathered from members. At the moment, most pension schemes will probably gather this information by sending members a form, asking them the questions outlined in the code and in the regulated Scorpion material. However, this approach has limitations, and in particular, where a member is being scammed, the scammer will often take hold of the information flow, offering to complete any forms and paperwork on the member's behalf, ostensibly to be helpful, but really in reality in order to provide answers that do not raise suspicions. And indeed, in a recent case before the Pensions Ombudsman, a sort of extract of which I've put on the slide here, Aviva suggested that it would be, quote, a waste of time, close quotes, to gather information in this way because the integrity of the information is questionable. Therefore, by following this approach, however diligent pensions administrators are once they receive the forms back, there's always going to be a risk that a number of potential scams will not be identified by gathering information from members in that way. So what's the solution to this? Well, over the last few months, we've been developing an alternative way of gathering this information from members, a way that should significantly improve the reliability of the data that's obtained from members and hence the integrity of the diligence process. So instead of sending members a form asking the questions, we're instead now able to arrange a telephone call with the member. And during this call, we'll ask questions of the member, so the same questions that we otherwise would have asked in the form, and have a discussion with them to understand, indeed, whether there are any telltale signs of pension scams occurring. Now, in order to be comfortable that we would be actually speaking with the member themselves during this telephone call rather than the scammer, we've invested in a piece of software that enables us, with the individual's consent, to check the individual's identity during the phone call. So in that way, the quality and reliability of the information gathered should be that much better, enabling trustees of pension schemes to have much greater confidence in the quality of the information provided, and hence more confidence in their ability to identify and appropriately act upon scam activity. And this additional level of diligence is already being used on a number of our clients, including ones where we're not the existing administrator. And the first telephone calls have already been held, and I think that's something that increasingly we're seeing clients looking to adopt. So that's a brief run through the latest position on pension scams and the code of practice. I think we've got time for one more question, and I'll take a question that's come through on the subject of pension scams. And given that Mark from Pinson's is still on the line, I'll take the opportunity to pick out a question that has a legal angle. And specifically, the question is, what is involved in assessing whether or not a member has a statutory right to transfer? So I don't know, Mark, whether you can take that question.
Yeah, that's fine. So it is important to know whether the member has a statutory right to transfer. There are two main things that you have to look at. Number one is their circumstances within your own scheme, and so in general, people have always had a statutory right to transfer up until the point where they get to 1 year away from their normal retirement date. If somebody's transferring before that point, then it probably is a statutory right. If somebody is transferring within 1 year of normal retirement date or afterwards, then it won't be a statutory right, at least in a DB scheme. And so it's important to make that distinction. The other question is about whether the scheme they're transferring to means that they have a statutory right or not. And what the Pensions Ombudsman has said there is that in order to have a statutory right to transfer to a scheme, there needs to be an employment link between the individual and the scheme that they're transferring to. In other words, their employer needs to participate in that scheme. Now, I'm not sure whether I totally agree with the Ombudsman's view there, but that is what the Ombudsman has said, and therefore that is the rule that schemes should follow. So it will mean needing to check the documents of the receiving scheme and understand the individual circumstances.
Okay, thanks, Mark. So we'll now move to close today's webinar. As I said at the start, a recording of this webinar will be available on our website within the next few days. And we'll also issue a Q&A document covering both the questions that we answered on today's call, but also those that we didn't get time to. So again, that will be posted on our website within the next few days, and we will send you an email when that is available. If you'd like to discuss any of the topics covered today in more detail, then please do not hesitate to contact your usual Xafinity consultant, or alternatively, please contact me, Mark or Darren, and we would be delighted to help you. So thank you all for joining. I hope it's been a good use of your time, and I would be grateful if you just spend a few seconds as you leave to complete the exit feedback questionnaire. Thank you, and have a good day.